1 week from today, the biggest ADR listing in history hits the Nasdaq. Alibaba held that record for 12 years. On July 10th, it dies. SK Hynix wants to raise $29 billion in a single offering. A $1 trillion company, running a 72% operating margin, trading at 6.7 times earnings. Micron trades at 13. Nvidia trades at 41. Something has to give. Either the cheapest trillion-dollar company on earth gets repriced, or the market knows something the bulls don't. Here's the whole setup in 6 minutes. If you're into this, subscribe. This is exactly what this channel does. Quick context on what's actually listing. SK Hynix is the number 2 memory maker overall, but in HBM, the high bandwidth memory that feeds Nvidia's accelerators, it's number 1 with about 56% market share. Nvidia and Google aren't just customers, they're dependents. The numbers are absurd. Q1 2026, revenue up 60% quarter on quarter to about $35 billion, operating margin 72%. For Q2, the street expects around $45 billion of operating profit, and 81% margin. That's not memory chip economics, that's software economics. From a company that sells physical silicon. 1/4 of this company's operating profit now roughly equals its entire 2023 market value. Hold that thought. Now the deal itself. 17.79 million new shares, just 2.5% dilution. Each sole share converts into 10 ADRs, around $165 a piece at the reference price. Book building starts July 6th. Pricing and Nasdaq debut July 10th. Every dollar raised is earmarked for capacity. The Yongin Megafab, a new advanced packaging plant for HBM and EUV machines. But here's the real move. Hynix is heading toward roughly $65 billion of cash by mid-year. It doesn't need the money. Raising outside capital for capex frees that internal cash for buybacks and dividends. This isn't a fundraise. It's the whole story getting relisted in dollars. Why would a listing change the price? 3 mechanisms. First, the accessibility discount. For 13 years, Micron traded at an average 35% premium to Hynix for essentially the same business, because US investors couldn't easily buy Seoul. The ADR deletes that excuse, and banks are already writing a 20% ADR premium into their targets. Second, index money. A Nasdaq listing puts the stock in line for the SOX, for the big semiconductor ETFs, and because it chose Nasdaq over the New York Stock Exchange, potentially the Nasdaq 100. That's billions in passive demand that simply could not own this stock before. Third, and this is the elegant part, the ADRs are fungible. 10 ADRs convert back into 1 Seoul share. If New York bids the ADR above Seoul, arbitrageurs buy Seoul, convert, and sell New York, mechanically pulling the Korean price up. New York doesn't just buy the stock, it sets the floor. Under the listing sits a bigger claim. That memory stopped being a cycle. Hynix is signing 3 to 5 year binding supply contracts, with prepayments across DRAM and NAND. Locked contracts mean locked cash flows, and analysts have responded by cutting the discount rate, not just raising estimates. That's how a cyclical starts getting valued like a growth stock. The supply side enforces it. HBM chips burn more wafer per bit. By end of 2027, HBM could eat 31% of global DRAM capacity, while regular DRAM supply grows just 8 to 9% a year. Everything is tight at once: DRAM, HBM, and SSDs. TrendForce now models the DRAM market going from $154 billion last year to over $900 billion next year. Read that again. That's the market multiplying 4 times over in a single year. Nothing in semiconductor history has ever done that, which is exactly why you should hold the applause, because here's the other side. This stock is up 8 times in a year. On July 2nd, it dropped about 15% in a single day, and it now trades below the ADR reference price. Price to book sits around 11 to 12 times, territory this industry has never seen. The bull case quietly assumes the cycle top is permanent. If AI capex slows, and it depends on $643 billion of cloud spending next year, those long-term contracts get tested, and the growth stock snaps back to a cyclical. at the worst possible moment. Add China's CXMT flooding in capacity by 2028, and a US class action accusing the memory makers of coordinating supply. ADRs improve access. They don't create value. So watch 3 dates. July 10th, where the ADR actually prices. The book decides, not the press release. July 29th, Q2 earnings, where an 81% margin has to show up. And then watch the Micron gap. If that 13-year premium starts closing, the repricing thesis is working. For Hynix first, then Kioxia, then Samsung. The whole memory sector is being relisted, one ticker at a time. If this was useful, subscribe. Next up, who actually pays for the memory shortage? None of this is investment advice. Do your own research.